All right, and we are live and direct. Good morning, all of you watching in Hawaii. Good afternoon to everybody else across the United States. It is the week before Christmas, and we're feeling festive. At least Mr. Jason Sipple is down there. So this is Ask Me Anything presented by the BYOB Money Multiplier team. We're here to answer all your questions around infinite banking, finances, money, investing, and anything else you want to throw at us. So we'll be spending the next hour with you. It's happy hour. Yes, even if you're out there in Hawaii and it's the morning, there's always a good Bloody Mary waiting for you. So it's happy hour. Grab a drink, grab a coffee, grab a water, grab what am I drinking right now? A Celsius Peach 5, baby. Whatever it is you're drinking, enjoy it. It's happy hour, and we're here to answer all your questions. Play this quick little 14-minute introduction. Just kidding. 14-second introduction. We'll be right back. All right. Welcome back, guys. Welcome to Ask Me Anything presented by BYOB Money Multiplier. My name is Stephen Nagy. I will be doing the intros and the outro today, just at the minimum. We'll see what happens in between. With that being said, let's go around the horn here and do some quick introductions, but get your questions in the comment section over there. We're going to answer all of those very shortly. But we'll start with Mr. Brian Fouts. It's glad to see a power back, Brian. But what's happening, man? All right,
you're on mute. First time here. It's okay.
Oh, technical difficulties. Now up here in Pacific Northwest and northern Idaho, but anybody else who's up in this area, there are some horrific winds that have been going on the last 12 hours. Lost power, trees down. Been someone actually got hit by a tree in my area. So a lot of bad stuff going on. A lot more flooding. So, but yeah, our power was out for most of today so far, but we have generators and stuff, so doesn't really interrupt anything we do. But yeah, pretty interesting. But that's pretty much the only kind of weather thing we really have to worry about up here is just power going out. So yeah, not bad though. Otherwise, it's actually sunny and blue sky right now, which is completely the opposite of what it was 6 hours ago. So who knows? With that, I'll go to Mr. Linus.
Thanks, Brian. Linus Nolt here from Hopkinsville, Kentucky. Finally thawed out. We had a couple days where temperatures went down to the single digits, and that's bad for Kentucky. Like out here, most people don't protect their plumbing, so under their houses, their pipes will freeze, and that can be quite a disaster. But yeah, we're kind of past that dilemma. So warmer days now. Happy to answer all the questions I can and help fill in the details here. I stay busy helping people with understanding the concept, first of all, and then potentially starting a policy for the infinite banking concept. So that's what I do all day, every day. Tess, what do you got?
I'm Tess Hulak, and this is Acro. He hates to be left out. I have been around insurance for over 30 years, this campfire for a few years, and when I found out how amazing it is, these policies and what it can do to change families' futures, I jumped on board to become an agent to also help clients get started on the process. So I'm grateful to be here. Appreciate all of you that are here. And now I will send it over to our only festive individual today, Mr. Sipple.
Thank you, Tess. Hello, everybody. And Andrew, this is not a filter. How could you make this a filter? Putting on this jacket, this fine tie, and this Mickey hat that I've had probably since I dated Snow White before I got married. So there's a fun fact you may or may not have known. So yeah, we're here to answer your questions. Last time of 2025, bring your best questions, try to stump us, have some fun with us, and just grateful to keep coming back here and being with all of you.
Yeah, get those questions in there. Yeah. Yeah.
We witnessed him getting dressed. We can attest to it's not.
Yeah, there was makeup being done when it was rolling the intro. Patty was over here fixing whatever looked wonky. So this is it.
Yeah. Well, cool. We only got a couple of questions. So as everybody said, get those questions in there. So we'll hit these first ones and then go from there. So Bow Hunter says, if you have more than one loan out on a policy, do you have a multiple loan payments back to that policy, or is it like one payment per policy, no matter how many loans you pull from it? Let me rephrase what I think what he's asking here is if you have multiple loans, well, one loan on a policy, do you have multiple loan payments back to that policy? I'm not quite sure what you're saying. So anybody want to explain how the loans work?
I think it would go ahead, Liz.
Oh, thanks. So it works more like a line of credit where it's like you're accessing some and then you're paying back on your own schedule. That's like the easy way I have to describe it. You could be taking multiple loans out if you've just not taken all your availability in the first loan, like you can be taking a second loan and then you pay it back on your own terms. It is not, I mean, you may want to design your own loan because you borrowed from yourself. So basically draw up your own loan with a payback schedule. So you could have set up 2 separate payback schedules because you took 2 separate loans and therefore have 2 separate policy loan repayments if in that way. But it's not like there would be 2 payments.
I always explain if you take like 2 loans, it's like taking one loan at the same amount. They just add up. So it's not like you take 3 different loans over 3 months, you have 3 different payments. No, it's just total of the total loan just increases all that happens.
Yeah.
So, and then you can pay it however you want. So yeah. A good question though.
Yeah, really good.
All right, Craig says, can we talk about the different health ratings and if it's beneficial to try and reach a higher rating if possible for an existing or new policy? For example, I'm standard non-tobacco. Can I do better? So Craig, yeah, you can. You can do better. So I just had a client that was standard and they had not issued the policy yet and they wanted to get a preferred rating because he's like, hey, I work out, I'm healthy, all this kind of stuff. And so we went back and said, hey, this client wants to get a better rating. What would they have to do? And they had to go get a medical because they didn't have a medical in the first place. So they had to get the medical done. And then they did get a preferred rating. Another individual had a standard rating, could not get preferred because of some note on the doctor's report. And they went back and got the doctor to write a different notes explaining what they meant, went back to the insurance company, and they got the rating improved to a preferred before they issued. So I'll let someone kind of talk more about getting the rating improved after you have a policy. You want to explain that one?
It's the same thing. It's a similar thing where you're going back to the doctor, you're getting, like if they said you needed updates or they're looking for a particular thing and there's something they saw in underwriting that got you the rating you're not happy with, or you've changed your behavior, you just have to go back and potentially do a new medical, get a new doctor's note, and you can upgrade it. I did hear, someone that's been in this industry for 40 plus years. We asked him this question. I won't name his name today, but he said, yeah, it doesn't really matter that much. I'm not really sure what he meant by that necessarily, because it does give you a little more efficiency because it's less risk. But as long as you're using the system at a standard non-tobacco, like the load for extra PUAs and different things are still going to be the same. So I'm not really sure it makes that big of a difference to your system.
So when I did it on this individual, it went to a preferred rating. What happened was it dropped the term insurance rider cost by a significant amount, which bumped up the PUA portion of the premium. And like down the road, like 10 years down the road, it definitely had a pretty good impact on the policy. Not like drastic, but you noticed it. You definitely noticed it. So that's how that works. And then the other thing to keep in mind, so when it comes to ratings, what do we mean? So there's a standard rating. That's what the majority of all policies are. They're standard. If you're super healthy above and beyond the average person, then you get like a super preferred or preferred. Then there's a lot of substandard ones, and they go down. I don't know, how far do they go down? Anybody know how far down they go?
Yeah, really far down, below like A, B, C, D, E, F, and I don't know if it goes below F.
Yeah, it goes below that. For sure. So as an example, so you get a substandard B or C or D, that's where you might want to lock in the insurability, depending on the reason why you got it, and then you can go back and try to get that improved up to a standard or even better. So I have a lot of clients that want to lock in the insurability, even if it is substandard, so they have coverage, because they might be more uninsurable down the road, not more insurable, and then they can go back if they get healthy or something or change whatever it is going on, cholesterol, diabetes, that kind of stuff, go back and get a better rating. But if you get beyond a D rating, then you can't typically do infinite banking with most carriers because they don't allow us to put in the specific riders in the policies that allow us to do cash value policies. So I have a client right now that just got a table F, and we're saying, hey, they can't do infinite banking right now. He's approved, but just not for infinite banking. So we're going to have to talk about what the other options are. Yeah. But good questions.
Yeah.
And that's this one right here. And then Matt says, hey, Chris. Well, Chris isn't on right now, but yeah. We have an insurance agency where we concentrate on whole life and FIAs. We buy real estate as well. I'd like you to speak with you and discuss whether or not there's opportunity to use your stuff. So Matt, you can reach out to Mr. Steven Nagy. So Nagy, S-N-A-G-Y at, what is it, chrisnoggle.com?
Yeah, that's perfect. Yeah, snagy at chrisnoggle.com works. And yeah, we can talk and see if there's an opportunity there.
Yep, for sure. All right, let's look at this one here. So RWJ says, if I have a 5,000 policy loan and I have a $10,000 cash value and I have room for 10K in PUAs, if I pay the PUAs, shouldn't that increase my cash value from now on and also increase my death benefit? Yes, yes, yes.
Yeah, great question. It depends what you want to do though. Like if you're replenishing your policy loan, that's going to reduce the amount of simple interest you paid. If you're looking to expand your system, like add more protection, more legacy, the death benefit, more cash value, then putting it in the PUAs is the way to go. So it just really kind of depends on what you're trying to accomplish. And that gives you down the road, if you're adding more PUAs now, say you make more money in the future, it gives you a bigger storage container for where you're trying to put money when you have it available.
Yeah. Cool. All right. What else? What's another good question here? Where's the health ratings? Let's go with this one. So, Don, it says, how would you use this to supplement retirement, take out loans and don't pay back? I mean, basically that is an option. You got to do the math on that though. And I was actually explaining this to a client here yesterday because they were saying, hey, what would this look like in retirement? And I said, first off, they're in their 30s. So keep that in mind. They're in their 30s. I said, you don't know 100% what the policy is going to look like at retirement because it depends upon how you fund it, how long you put in premiums, if you change the premium allocations. There's a lot of factors that go into that. But generally speaking, when you get closer to that, the insurance company or us can illustrate the maximum loans for a certain period of time starting at a certain age. You can actually illustrate that out. The max you can take out via loans, not paying them back, and then not lapsing the policy. And then if the focus really is retirement, there are some companies have a specific policy that is built for retirement where you can take out, I think it's 95% or 90% of the cash value and never pay it back and never make another payment. That's One America, I think. Select. So there actually are options. So if that's a good conversation to have with a mentor, but that is the overall strategy right there. You just have to make sure that you funded it with enough upfront for that to work. So I don't know if anybody else had any comment on that.
Yeah, what it would often, well, I mean, you, like Brian said, you got to do the math. But what often ends up being the best method once you're actually taking it to supplement retirement income is actually to do actual surrenders up to the cost basis of the policy, because you can access surrenders up to the cost basis of the policy tax-free, at least under current tax law. And so doing that first before then taking loans that you don't pay back for supplementing retirement income is often how it's going to be the most efficient. But running the math at that time is really the answer. Yeah.
Yeah.
There wouldn't be tax on that base that you took out of the surrender, the cost basis.
Yeah, just up the cost basis, then you're switched to loans. That's what Linus was saying.
Yeah. And then Chris has a video out there where he's doing it on his daughter, and he shows that actually happening down the road, taking out for retirement. It's a pretty good one. And also the book, Becoming Your Own Banker, it does show some of that stuff in there as well. So there's some good examples out there. Christian, what's going on, man? He says, if I have 10K, are there any good investments besides putting it in the stock market? Well, first off, this is not it's not educational. This is only educational stuff. No financial advice here, all that kind of stuff. Anybody else want to take that one?
Well, I think it's always best to start with a policy, because if you're going to take the funds out of the policy to invest it, at least you know you started it in the right place.
Yeah, he has them. I'm pretty sure.
Oh, he does have them? Okay. As far as, like you said, investment advice, I'd recommend PMC. Stock market is not something I play with, but again, we can't give financial advice.
And there's a longer answer is invest in what you know, like, and trust, or know,
Yes.
like, and and understand. Because I've unfortunately had early in my life, a lot of unsuccessful experiences in investing because I didn't know what I was doing. I was trusting some, guy that was very flashy and all that, and to the tune of, I mean, it's over 500,000. I probably lost, to that kind of stuff. So you got to be very careful with your money. But I mean, also the one thing I learned is control. A lot of investments that are out there for the average person, you don't control them. Somebody else controls them. So if somebody else controls it, then you got to think about, well, how are they making money? How am I making money? Because like you put it in the stock market through, like, let's say a financial advisor or mutual fund, they make money no matter what. You lose money, you make money, they still make money, but you can lose money. So it's like, where's the risk line, and how do you control and mitigate that risk is a big thing that you got to understand. And unfortunately, most people don't put in the energy or effort to understand that. Real estate's a great example. If you put in the effort, and I say minimum 3 years of getting good experience to get into real estate, you can make money in that. But if you just take your money and toss it into some investment fund or something else, you don't have any experience, you don't have the education, and the risk is on you if they lose your money. So there's just lots of things to consider. But you're asking about $10,000. That's the challenge right there. The more you have, the easier it is to open up better investments, in my experience.
You know what we didn't say that we often do say in this? For $10,000, sometimes the best investment is an investment in yourself with education. And that's kind of how I started, is with the educations within the platform, like the accelerator program, so that I could learn how to be a good investor. So for me, at that point, that's where I actually started focusing on education, because I wanted to have a strong background in something that I was investing in. Exactly like Brian said, know, like, and understand it.
What, to that point, there's one guy that I would recommend you check out and go listen to, and it's Andy Tanner. So he's been on one of our live events. He's an acquaintance of mine, and he's obviously one of Robert Kiyosaki's stage speakers. He retired from that here, I think, like 2 years ago. Doesn't do it anymore. But I've known him for years, and I have a lot of clients that have gone and worked with him because he has a couple courses, and he has an options course, and that he does, like, every week he does this video stuff, and it's really good. I've been through a lot of his stuff, and that's investing in yourself, but he also has an opportunity to learn how to put your money to work through options. And keep in mind, Andy is an anti-traditional investment guy. He's against 401ks, all that kind of stuff, against just putting your money in the stock market, but he's an options guy. So he's called the notes trader. So that was his thing when he was with Robert. He was always the notes guy. So paper assets, but he might be someone to check out.
Yeah, sounds like a great plan.
And this is going to tie, and you guys covered as much about this, but I think it was mentioned, but if it wasn't, this is what Shauna is kind of asking or bringing next, is look at this as putting it in the and asset, where you put it somewhere where it's guaranteed to grow, it's creating protection, and depending on how it's set up, you'll be able to borrow or collateralize a large portion of that money. Then you can go out and invest yourself, whether it's with Andy Tanner or go to Private Money Club or get a course with Noah Harris. Whatever that looks like, you can start investing in yourself to learn how, when you have more money, how are you going to actually put it to work? Because what I would say with 10,000 is you might get a little return on it. You're playing small ball, which is awesome. If you're willing to think long term, okay, I'm going to hit a single with the 10,000. I'm going to get a little return on it. But what a lot of people are doing, since we're last in line for our money, is we get something like this and we think we have to go make a big ROI on it, because it's the one chance where we've actually saved money versus playing the long game with it. So put it in the and asset and then go put it to work.
Yeah, perfect. Win-win.
Yeah, like my first thing I ever did was subject to investing in real estate, but I paid for a $12,000 course, which I would never recommend doing, by the way. But I did make that money back multiple times over the following, 18 months. But I took that investment. I said, okay, I can put it somewhere, but I put it into that first and into myself, and then went and created a bunch of cash flow and, money from that. So
yeah, first job, you got to make money.
Yeah. All right. So Teila Shiongo says, can I insure, I think you mean insure, can I insure my child alone by starting an account with $10,000? there's a lot of questions that we need to answer about that first.
Yeah.
Depends on the age of the child. So if they're over 17 or under 18, that's a big difference. And it's going to depend upon you as well. If you're the guardian of a minor, then the scope is going to fall on you first. They're going to look at you first for coverage, then the child, unless you're uninsurable. And then if they're over 17, they're still going to look at you, but then they're going to start asking why you want to insure them and not yourself, or why aren't they insuring themselves? So there's a couple of questions that have to be answered first. And then when you say with $10,000, yes, you can, but there's going to be a premium. So are you meaning a $10,000 per year premium deposit into the policy? Because you can't do like a one-time premium and be done. That's a taxable contract, by the way. We don't do those for infinite banking. We don't recommend them. It depends on if you're talking about an annual premium or dumping or whatever. So anything else on that one?
No, I love it. You just read them and answer them. Read them and answer them. You set them up and knock them down. It's like you're throwing the ball up with the big red bat and you're hitting them out of the park.
There we go. Well, this one you can take this one, man.
Crushing it.
So hey, Adrian says I'm currently on my annual premium payment that is not yet due to be paid. I have some capital coming back from a real estate note investment that I want to put in my IBC policy. Should I put it in my PUA or to pay back the loan of my real estate investment that I took from my infinite banking policy?
Great question. We touched on it earlier. What do you guys say? What say you to this one?
I actually prefer to build up that PUA because the long term is what I'm looking for. But you're right. It depends on what your goals are. Do you want to pay back the loan and reduce the amount of interest you're going to pay going forward? Or do you want to build up the pot so that your death benefit grows and your cash value grows, which means that will continue to compound year after year?
Yeah.
Breaking announcement. I see that there's going to be a future cage match between Miss Tess and Miss Shauna Decker. One's going to put PUA, one's going to do loan, and they're going to fight to the death to settle this once and for all.
So here is answer that one, Adrian. Cage match. I want to see this one. Get an AI image of that. Is if you're going to put it back into the loan, repay the loan back, and then borrow it back out to keep doing real estate, then I'd put it into the PUAs. If you're not going to be using it at any point anytime soon, then it might make sense to pay back the loan so you're not paying interest on that loan.
Great point.
It depends on really what you're going to be doing over the next 3 to 6 months with that money. Whether it goes through PUAs or back to the loan, regardless, it's what you're going to be doing with it down the road that to me would answer that question.
I actually like that. You're right. Because if you're going to put it in to take it back out, put it in the PUA and then pull it back out. It'll be a little bit less.
Correct. Okay, so let's see what was this question here. So Shauna had this question earlier. She says, I had this question this week. If I have 100,000 and I can put it into real estate or the policy, how does that compare? Love to get your take that I mentioned tax on seed harvest concept.
It's the and asset again.
And I think if you come in having a plan, like if you know, like I'm working with pretty excited about this, working with someone who is basically buying and rehabbing mobile homes, and you'll buy them for 15 or 20 grand. Then you'll spend 15 or 20 grand rehabbing them. And then he's been, seller financing them for 5 years to the person. So then he ends up, charging them a super fair interest rate, but he's still making about $30,000 per mobile home, over a course of 5 years. So he was doing that all cash based before. And I talked to him about it. And so now, he's putting, like, if he had 100 grand, he would do 20,000 a year or 25,000 a year, overfund it by 75 or 80. So you have 80 to 90% capital immediately. Take it and go put it into that same strategy I just talked about. And then he's repaying the loans. And now he's making money on both sides, right? Now he's earning the guaranteed interest, most likely earning a dividend. And with the money that's coming back in from the buyer of this mobile home, he's now making a spread by paying himself back, increasing it, and just rinse and repeat, and do it over and over again. Like that's exactly how I would set this up. And it depends first on how much is the investment that you're making in real estate. Like, is it a 20, a 50, a 75? Like, what do you need to start to get that going?
Yeah. So compared to the real estate versus the policy, some other things to keep in mind is that with the policy, you have the growth, you have the privacy protection, you control the loans, you have the guaranteed tax or death benefit, but you also have a premium. So you got to keep in mind there is a premium that has to be funded on a monthly or annual basis. And for $100,000 like lump sum going through that, it's going to be a 15 to 18,000 in most cases, somewhere around that annualized premium. So you got to keep that in mind. Whereas the real estate doesn't have any of that. But with the real estate, when your money's locked up there, it's not doing anything else for you. It's in most cases not really protected inside the real estate either. But it's just in that one spot. The and method they call that, right? So it's in two places, like you were saying. Now, also the mention of tax on the seed and harvest concept. So, I mean, on the seed and the harvest, what they're talking about is like, if you have if you're a farmer and you go buy $5,000 of seed and you harvest that, or you put that into the ground, you harvest it 6 months down the road and you make $50,000, which one would you rather pay taxes on, the seed or the harvest? Most people would say the seed. So in most cases, why we say that is because we want to run the money through the policy and let it grow tax-free and not be taxed on the harvest down the road. But I'm not really sure how that plays into that example. But
I think it's thinking long-term, right? It's like when, or just ask it a question, when do you want to kill a monster? Well, when it's a baby monster, right? Like you get that done now before it grows into something that's going to be a behemoth and you can't take care of it in the future. So
yeah. I have someone right now who's got a $2.7 million 401k. And they actually have a problem. That sounds cool, but they have a problem. It's a huge taxable problem.
Yes.
And because also, get this, they don't really need to take the money out to live. But what happens when they pass and what happens to that money too is what they're kind of asking. I'm not a tax expert. I'm not going to answer that question, but yeah, they actually have a problem now because of that. So they're trying to figure out how to resolve it. But yeah. So Tyler's got a good question here. He says, having multiple policies must be hard to keep up with. How do y'all do it? Well, I mean, I guess for me,
faster.
What's that?
I said we just run faster.
Yeah, there you go.
I'm just being stupid there.
I mean, if it's only a handful of policies, it's not that hard to keep up with them. I mean, an easy spreadsheet. But the challenge is having something that actually, in my opinion, that is constantly updating your information without you having to do it automated. That doesn't really exist yet.
Well, yes, yeah.
Yet. So I'm pretty excited about the vault. So there.
Oh, did we freeze?
no, I think Fouts is frozen. It's windy. It's very windy. So he'll come back in a second, finish his thought. He's probably going to say the vault is going to be able to help you do all these things and manage the policies. It's not that difficult. I mean, I don't know. We have 4. We'll soon have 5. So that doesn't seem like much to manage. We have on my spreadsheet, and I've shared this with other people that I've helped get started. It's when did you put the policy in force? What is the annual premiums? What's the paid up addition? What's the interest rate on that loan? What's the mode of payment? And there's how much is outstanding, just the basic things. And you can pull all that from your dashboard with any carrier. We actually go in every Tuesday and look at the cash value growth for fun. And we're kind of tracking, and we even have a question. We're like, wait a minute, this one policy hasn't had any growth in the last 5 days where every other one's went up by a few dollars every day. So what's happening with this one? So it starts getting you closer to your money when you're tracking and looking at it every day. At least that's my belief. I think the closer you are to your money, the better you're going to be.
Oh, yeah.
And I actually set up my policies knowing that I wanted them spread out so that the premium wouldn't hit all at the same time. Like I have one policy in March, one policy in July, one policy in October, and I just have that memorized, and I know that the document will come in. But again, like you said, an Excel spreadsheet. But really now I don't use the Excel spreadsheet. I just use the vault. Yep. And you do get notification from the insurance company. If you're not set up automatically, they will send you a notification.
Yep. So Dex is asking, what is stage 4 rating? So it's kind of weird. So a stage A rating is actually standard. It's kind of a weird thing, but that's standard. Then you have B, C, D, E, F, G, H, I. And so it's a health rating. So if you get a stage 4 rating, that means you're more unhealthy than a preferred, select, standard, table B and C. You're a table D. So you're more unhealthy than all of those other levels. the further down your level is, the more unhealthy they are viewing you. It can be things like, your prior health history, cancer, or that kind of stuff. It can be your current health situation. Height and weight ratio plays a big one to that, by the way. Cholesterol, medications, if you're a smoker, that's a standard. So that's another rating. So that's just what it means. So yeah, and those are not good to get. Anything below a B is not good usually. But you can still do infinite banking up to stage 4. And by the way, carriers are all different on this one. So I just got someone that went from a table E or an F to a table 2 by changing carriers. So sometimes if you get a rating like that, we will go and ask other carriers what they would consider for you so that we can maybe switch to another carrier that might take on, a more risk is what they're doing.
Yeah, or even switching to a carrier where table 6 or F still works for infinite banking, as opposed to maybe another carrier where table D or C might have been the maximum that still worked for infinite banking.
Yeah. But the one thing to keep in mind is that if you get a rating or a denial or something like that, the other insurance companies can still see it. So I get that question quite a bit. Well, we'll just go to this one and not tell them this. Like, no, once you don't do that, you tell the truth, but they can see it. Although they can also see that prior result in most cases.
Yeah, that's important too. Honesty. That's honest.
Yeah, because you don't want them to find out if you lied, because then it goes away potentially. All right, Craig says, I think there is a huge ROI by just starting, even if it is 10K, and that's true because it's time, right? Double the penny a day and how much you have in 30 days, right? $1 million, right? So definitely start with where you're at. This is kind of funny. Is that the real Shauna Decker?
I'm sure it probably is.
Yes, it is. So she has decided not to join us. No, that's her, yeah. Craig says, wouldn't buying the paid-up edition instead of paying the loan be the equivalent to borrowing from the policy to purchase PUA? It is actually, yes.
In a sense, yeah, and I have done that actually in some cases where it did make sense for the long term to, hey, let's purchase these PUAs now, get that death benefit increased and increase the amount of cash in the policy that's compounding. I really like that for the long term, but you definitely have to be aware of that basically double loan that you're creating now. That is a liability charging you policy loan interest. The thing that often or that played into that decision for me and others that I've helped do that is whether they want to put that off to further down the line to buy more PUA death benefit like that, or try to max it out now and still have that ability in the future. It just kind of depends on what your goals are for that.
Yeah.
And here's the thought I just have, not shared this before, but I have a friend who's a dentist who's been practicing this for, infinite banking for 20 plus years. And one of his biggest concerns is he's always used, instead of using direct policy loans, he's always used lines of credit from the bank for the most part. And so he's paying things back, in a structured payment manner. But one of the things he has is he's made a lot of purchases, expanding his dental practice or purchasing real estate that's not cash flowing. And so now the amount, because he's got millions and millions of dollars throughout his system of policies, and he's probably got most of it out to work. His big concern now is that the interest is so high on a yearly basis because he didn't have a plan for, like, is this a performing loan that I'm taking? Right? Like, there wasn't that thought like, oh, I'm just going to get this, expand my asset collection, have, this, I can use this a bigger, and he makes millions of dollars, but it keeps getting bigger and bigger because he doesn't have cash flowing assets that are paying his system back.
Yeah, that's a good point to bring up, because the other person asked about multiple policies. How do you manage them? Well, one of the things that I've never experienced it, of course, but like Chris and Devin have, where if you have too many policies and you're having to borrow money, it's a lot of work to go and request 10 different loans or 7 different loans and then schedule all the payments back, and can be very cumbersome. So they use a bank that gives them a line of credit based upon all of their policies' cash value. So they have one line of credit. It's a different way of doing it. There are pros and cons to doing it that way, but that's one way people do that have lots of policies manage the loans. And then I was talking to Desi Arnaz, that he has a lot of policies. He does something very similar to that, actually. gets banks to do that because it's just too many policies. And since his are on a bunch of different people, it's even more cumbersome. And 3 different companies, insurance companies. So that can be challenging. So Shauna said that regarding the whole like payback PUAs or not, she was saying she would do the loan, and if need, pay the premium. I could pull it out again. And more so, people who haven't grasped the concept. So the idea of $100K to real estate is sticking more to the brain than IBC. Yeah, I mean, potentially. Yeah, potentially. But once again, it depends on what they're doing with the money. I'm not sure about this question. David Dorothy, happy holidays to all. PMC website, what is the lobby and what are the details?
Lobby.
Mr. Stephen Aggie, you know what the lobby is on the PMC site?
Is the lobby and what are the details? Yeah. The lobby is just a community forum. So on Private Money Club, it's an open community. You know, it's anybody can join and be a free member. And so within there's the community forum, and the lobby is just the place to post general comments, introductions, say hello, and interact with other people. So highly encourage, if you're looking to connect with real estate investors, private money lenders, just learn more about, how all that works. It's a great place to network and build some new relationships.
Okay. It's one of the groups in the chat section. Okay. In the community.
Yeah.
Okay. So I was looking at it. I have them in it right now. Okay. I didn't see it over there. It's in the chat section.
Yeah.
Gotcha.
Yeah. It used to be called Introduce Yourself, but people are using it for all general things. So I went in with my tech development skills and I changed the name a few months back.
That's why it was broken for a while.
Go, Steven.
Yeah.
Yep. Happy holidays and blessings to everybody else as well. All right. Terrible, just awful. Positive. See, doing the prep work on getting a first lien. So awesome. First lien HELOC and starting infinite banking. The first lien requires a reserve. Does the whole life count towards the reserve at First Savings Bank? Trying to figure out timing for the infinite banking. You'd have to ask the bank because your reserve has to remain liquid. So yes, it could be part of it, but you couldn't leverage it. You couldn't like loan it out. So think of it like this. If you have emergency reserves, like 6 month, 3 month reserves, like I like to keep those in policy, but I don't use it. I don't loan it back out unless I absolutely emergency need it. I think this might be kind of the same thing. I'm not sure. Jason, do you know about that or not?
I do not. I do not know if they would. I mean, I just ask your whoever is helping you with First Savings Bank. They're a bunch of really proficient, knowledgeable. They're practicing infinite banking, the ones that I've worked with at least. So they should be able to at least answer that question pretty clearly.
Yeah. Yeah.
And you have such a cool picture. The name is terrible, just awful. Like we got to turn that around in 2026. Is there a chance? Can we like rename that to, just positively radiant or something like that? Just glowing like you are in that picture there, the red to green.
Yeah.
So, it's very Christmassy too, by the way.
Yeah, it definitely is Christmassy.
Yeah. But First Savings, they probably have a list of what qualifies. They probably want it actually held with them, by the way. I bet you it's probably the thing they want because then they can control it and see it. If they can't control it and see that it's liquid, what if you went and leveraged it and now it's not there anymore? So they might require it to be actually held with the bank. Now that I think about it.
And we got the name. I'm a Twitch streamer of video games and I'm a horrible gamer. LOL.
I'm not sure what Twitch streamer is.
What's it? Twitch? Yeah. I don't know what Twitch streamer is.
That's just showing our age. Somebody knows what that is.
I do, but I've not been on it.
What is it? Explain.
Well, the Twitch is more of like a streaming platform, so it could be compared to YouTube or even StreamYard here.
Well, we're going to say in 2026, you're going to be an awesome Twitch streamer of video games. There you go.
Yeah, you're going to go viral. How about that?
Yeah. Hey, that's it. Go viral.
Yeah, my son loves to watch those kinds of things. He's autistic, but he loves video games, and he'll just watch people playing video games like for hours, and my brain would melt. Well, guys, that's all the questions I see in there so far. So, here we go. Keep them coming. Okay, the first lien reserve can be a retirement account. Yeah, like a 401k or an IRA, something like that, potentially. Okay. Yeah, you have to ask if cash value life insurance qualifies, and they should know what that is. I mean, it's kind of funny. I've always
I
asked.
think it would qualify, Brian, just from the way you just phrased that question. The question though was more, when do I start my IBC once I get the first lien in place? And once you figure out the cash reserve piece and know that just know it's going to take, depending on your age and what you're applying for, it's typically like 4 to 6 weeks. So you can kind of line up your closing for your first lien HELOC and your policy to have them running parallel at the same time.
Yeah. Yeah, because I mean, cash value life insurance, I mean, it is, all the financial institutions know exactly what it is. If you've ever filled out a personal financial statement, it's listed on there as an asset. And most people don't know that. And I filled one out not too long ago, and it says, cash value life insurance, how much, and then any outstanding loans on it. So they know exactly what it is, and they're asking. So I've had someone say, I don't know if this is legit or true. And I said, hey, have you ever filled out a financial statement before? They're like, yeah. Have you ever seen this question about cash value life insurance? They're like, yeah. Oh, wait, is that what this is? I'm like, yes. They're like, oh. They had no idea. That's kind of funny. Mr. Navigate Your Ventures. How many on the panel today will be sharing in January's PMC virtual? The last one was amazing. Thank
you, Shane. We're excited. We're excited to come back and make it even better than last time. This one's going to blow that one out of the water. That's the prediction. Snaggy's already working on it every day. That's all he does. The guy barely sleeps. Look at him.
He's not anonymous anymore. You're calling him out by his name.
He was trying to be anonymous?
Oh.
See, you want to give an update on that event? No?
So is that not the blueprint event that we were going to do?
Yes, it is.
Okay.
It was so good, they couldn't keep it to 2 days. It had to expand to 3.
Why do you guys pitch it? What are we talking about?
The 3-day?
Well, it's the water hose. It's the original. It's almost like the old 3-day essentials, which is how I got started. It's like drinking from a water hose, which is what we've all said. And it's the actual tool that I utilized way back in the beginning of lockdown. I would pick one thing from each one of those 3-day events, and that's how I got to where I am today.
Yeah, I mean, it's $100, so spend the $100. It'll be way better than anything you're buying for Christmas, and rock and roll in 2026, right?
And the $100 gets you the recordings that are timestamped so that you can watch them later.
Yeah, recordings, physical workbook, the bonus sessions with Jason. I'm sure there's some other stuff too, so definitely do that.
Yep. Yeah, good event. So.
Yes, it's similar to the original that was years ago that we haven't had in a while.
Yeah. Cool.
Great event. Don't miss it. I've never missed one in about 6 years.
So Jolie has a question here. It says, just clarifying, if you start a policy with a small amount for the PUA, are you still able to add additional PUA in the future?
If it's designed for it, it has to be specifically designed with that in mind to be able to allow that. But yeah, that is a possibility.
Yeah. So, I mean, I have a Lafayette policy, and every year I can put in significantly more PUAs than it's scheduled for, but it's a 60-40 base policy. That's it. No dumping. So there can be, it's just, you have to kind of look at what your goals are, what you know, because here's the bottom line. You can do that, but you've got to be careful about trying to guess where you'll be at in the future. Because, I mean, you build a 15-pound bucket to hold 15 pounds or gallons of water, but what if down the road you can only put in 9? So you got to be careful of that. And that's why a lot of people, by the way, they start with what they know today, and then they do the second policy down the road to accommodate their different situation. But that's where one of the conversations with one of us comes into play, to talk about what the options are and how to design those kinds of things. And we'll put the link in here in a moment to schedule a call. All right. RDBJ says, on a policy that's 2 or 3 years old, when paying additional PUA, how much does it increase the death benefit? Is it basically dollar for dollar?
No, it can't be dollar for dollar. Otherwise, it wouldn't be life insurance anymore.
Yeah.
It's always going to be more than $1 for $1, even all the way out to the end of the policy, the maturity date, which is usually going to be you're aged 121. But yeah, the actual question there, it varies. It depends on the person's age, health, gender, all the things. It could be anywhere from, say, $1.50 of the permanent paid up death benefit for every dollar of PUA premium, all the way up to I've seen like 14 times for a kid. So it's kind of all over the board. It like I said, it depends on all the circumstances.
Is that all the questions we got?
We did it. Look at us, champions.
But I will add for that last question. For the most part, it doesn't matter necessarily what the multiplier of death benefit is on your PUA premium. You'll still have right around that 90% immediate liquidity, cash value of whatever PUA premium dollar you're putting in. So that part of it stays mostly the same or very nearly the same, no matter what that actual multiplier ends up being on that death benefit. But if it is important to you, that is actually a quote that the insurance company can give you before you decide to make the payment. Is like, hey, if I make a extra PUA premium of $1,000 today, what would that increase my death benefit? And they can tell you that.
Yep.
And it's always going to buy more death benefit first. So PUAs, like when your dividend buys a PUA, it always does three things. One, it's always going to buy more death benefit. Why? It's life insurance. Two, it's going to give you higher cash value because, like Linus was just saying, it's going to be usually over 90%. So you put $1,000 in, you have 900 new cash value dollars is typically how it's going to look. And three, it's going to increase the likelihood of dividends. And I always say that's just because you're adding more fuel to your system. It's a healthier system.
Yep.
What if it's electric?
We're against that. We're against that. Too much control on the other side. Shut us off, Steven. It's weird.
There we go. All right, this is a good question here. I'm a bit confused on how the interest rate works with the loan from the insurance company. And by the way, this is an interesting one because it doesn't really seem like any other types of loans out there in the world function like these ones. They're very unique. Anybody want to explain that?
Sure. I'll give it my quick answer here. Say it's a $10,000 loan, okay, we'll call it 6%. That's $600 in simple interest over that year that you'd pay to use that $10,000 that you collateralized your money against. If you pay it back in 6 months, you'll pay $300. You're only paying interest on the outstanding principal that you have borrowed.
Yes. So someone said, well, how do they calculate that? 6% divided by 365 is the amount of interest every day that you incur. But the cool thing is, the way Jason explained it, is that when you make a payment on a car loan, a HELOC, or anything else, you're paying two things: interest first, then principal. With a policy, you're paying principal only. At the end of the year, depending on what company, they're a little bit different, but end of the year, then they will send you the amount of interest that you actually owe. You can put it back into the policy loan or pay it, but they only charge it once a year. So your money is working harder for you. This is the way I kind of view it with these kinds of loans, because you pay $1,000 on a car loan, $800 might go to principal, $200 goes to interest. With this one, $1,000 goes to principal, which means the balance decreases faster, which means less interest.
Yeah, you increase the spread when you're paying back the loan. Like if you pay it off, and you can move that up or down depending on how your cash flowing, what things are like how much is available. So that's the best part, is you have full control. Like we probably overlooked, we're just telling you how the interest works, but you have full control. Like you could take my $10,000 example and just extend that out over years of paying it back. Just pay the simple interest every year, or you can pay it back in half the time, a third of the time. And when you pay it back faster, if you're making a spread, like if that money is out doing something for you, you're going to increase the spread because your actual interest paid reduces significantly. It's usually by almost half, right? Like when you're running it through the vault, you always see, hey, it went from 6 to 2.85, or 5.5 to 2.5, or whatever. It's usually almost half when you're paying it back consistently, persistently, like the banks want you to. So.
Yep. Like this question, this is pretty funny. So Dennis in Photography says, the confusing part for me was that they adjust the difference because it shows the entire first year interest, by the way, that's what they're referring to. Mm-hmm. But as you pay it, they will decrease the amount owed based upon your payments back on the policy. I'm guessing, Dennis, and you have a One America policy because that describes One America right there.
Yeah, because they take the interest up front. in
Yeah,
some
and then they're crediting you back. Yep.
Yeah,
Yeah,
well, they
yeah,
don't
pretty
take
bad.
it. They'll just show you what it's going to be at the end of the year.
Yeah.
You can't borrow that. You
block
can't
it as
borrow
an
that amount.
advance.
Yeah,
Yeah.
they won't let you borrow that amount of it. But once again, though, this is the kind of thing I always tell people. Once you experience it, you're like, oh, okay, moving on. You don't really think about it too much. But yeah, once I understood that, that's how it worked. It was a thing of the past. Exactly.
And that kind of thinking right there, just for everybody watching, everybody using this is something I'll talk about tomorrow in my webinar. But what we see, I see it a lot, and I know you guys do as well, and test, the guys and gals. But when you talk to folks who start the policy, starting a policy is not infinite banking. It is what at Dennison Photography just shared. It is doing the thing. It is experiencing the thing. It is watching yourself do it. And it is learning the lessons and continuing to do it and showing up over and over, coming to Ask Me Anythings like a lot of folks do, coming to the campfire, other conversations, Wealth Wednesday webinars or the WTF or whatever it is, just being around the people all the time, going into the lobby in the private money club. The more you're around this thinking, the more this is going to click, the more you're going to accelerate.
Yeah.
And it's really important to make sure you're involved with it. That's my point. It works when you work it. You can't just get a policy and expect it to work.
Yeah. Good point. Couple quick questions. The last one's here. Is there anything to prepare for before funding the policy? Have the funds available. That's step one. Another thing a lot of people do that we sometimes recommend is you have a separate bank account, checking account that is specific for funding and borrowing and receiving the funds from the policy. It just separates those transactions, your banking transactions, from your day-to-day, stuff inside your checking account, so it doesn't all get, jumbled together. So a lot of people will do a second policy, but other than that, you got to go through the application process and the approval process. So if you've already been doing that, which I know you have, so just kind of go through that process. And yeah, I can walk you through what the steps are, but just have the funds available, have a separate account, and that's pretty much it. And I'm not sure where you're at in your application process. I got to check. Yeah. All right, we got some more questions just came in. So Terrible Awful says, I just heard Chris say to pay back extra interest on policy loans. Where does that extra interest go? Is he just saying that so you'll pay it back faster? Yes and yes.
The extra goes into PUAs because once your policy loan is paid back, it can't take more, and so that's where PUAs is where the extra needs to go. But if you are building up quite a bit of extra money that can't fit into the policy, you may want to look at opening up a second policy just to have room for that extra cash flow to go towards. So that's also potentially a thing further down the road.
Mm-hmm. Yep.
And it does. Like if you're buying a vehicle or you have the opportunity, like say you're taking a promissory note from yourself. So instead of paying it back at 5% or 6% or whatever the insurance company, you decide, hey, I'm going to pay it back at 10 or 12. It's just going to replenish it faster. You're actually recapturing that interest in that manner because you're including that in your payment. And then like Lynn has said, if you get to the point you can't stuff anything additional in, you find out, can I add additional PUAs, or do I maybe need to expand my banking system? So basically the same thing that was just said, just a little different, maybe, possibly.
Yep, for sure.
I think.
Yeah. I know dividends are guaranteed, but one statement one of you made a short time ago made me think that what are the dividend variables or individual variables to a policyholder getting dividends paid? Just having a policy. That's pretty much it.
Yeah.
Because it's based upon the cash value and other variables inside the policy, but yeah, I mean, it's just based upon the structure of the policy and how much dividends you'll get. I don't really focus too much on dividends, by the way. I'll just be honest, because how they're calculated is a very complicated thing behind the scenes, and every company is slightly different. I just look at my forecast of what it's going to be, my cash value down the road. That's just what I focus on, because the dividends is part of the whole thing. So I just look at the numbers and say, okay, when's it efficient? When's it hit this point? How much is it going to be down the road? If I put in $1, how much do I get in growth? Because the cash value grows not just by dividends. So I mean, that's a good question to have on a conversation with one of us, because we all have different answers to it. But I have to look at the illustration.
I will say this: dividends are tied to the profitability of the life insurance company, and the companies we use, the mutual companies, They have been profitable and paid dividends every single consecutive year for well over 100 years. And so that's pretty dependable without actually being guaranteed.
And multiple ones recently in the last week have announced record dividends. We've had record dividends in this year, and we've had record, that's multiple of the mutual companies that we work with, because they've set themselves up for long-term success.
Mm-hmm.
So like even a couple of years ago, maybe they weren't as profitable as they could have been because they sold off a certain part of their business. But now they've set themselves up for long-term success, because that's how they're always thinking. They're like, how will we be profitable for the next 100 to 150 years?
Yeah.
That's a big difference compared to most of the world. That's why they are the bank's banks.
Yep, for sure.
Because even in the days when I worked inside the industry, at the end of every year, that last quarter of every year is when we take a look and review reserves and premium writing and rates. And that is what will trigger, because they're so conservative in the beginning, they'll take a look at that and make adjustments based on what they've seen play out in the first part of the year, so that they'll do rate adjustments, or they'll do the releases of maybe some reserves on claims. And that does affect the dividends, but they can't tell you that until they've gone through the process of reviewing it every year.
Yeah. We got some questions piled in. Let's get through these things, guys. There's some good questions too. So Tony has a follow-up question. Do loans against policy impact getting or not getting dividends, or the amount of dividend? Great question. Direct versus non-direct. We work with non-direct, which does not impact the dividends. Loans do not impact the dividends. So we don't use those kind of companies. As an example, someone asks this question: do you work with Penn Mutual policies for policies? Are there significant cons to their policies? They are a direct recognition company, which means if you borrow from the policy, the amount of dividends you earn are going to be affected, meaning they typically come down a bit when you borrow from the policies. So it's hard to forecast those numbers on a Penn policy, because when you start borrowing, it's going to impact the amount of cash value that you have down the road, because dividends do change. Penn's a great company, don't get me wrong, but we just don't typically write with them because of that reason. It makes it very hard to know your numbers down the road. So
yeah, and so is Guardian. Guardian is also a direct recognition company. I know someone, maybe the next question mentions Guardian.
Yeah, Northwestern I think is as well. So RWJ says these companies use fuzzy math though. My Guardian policy charges interest upfront, like One America, immediately sees the interest amount on the loan, but it doesn't match what it should be. And that's because they adjust it as you pay back the loan. But Guardian, by the way, is a direct recognition company. That's why we don't typically use them in most cases. And the fuzzy math question, it's I don't know if I would say it's fuzzy math. It's just that every company is different on how they operate and how they they do the math. So you've just got to understand on your policy with that company how the math is calculated. And you can call them up and ask them, by the way. They will tell you. If you call them up and say, hey, how's this work? They'll tell you. Or you got to find someone that knows the math, I guess, maybe. Yeah. Yeah. And then this is kind of a funny one. Is Stephen the one who had the knowledge on trusts? Well, I don't know if Stephen's not an attorney. So for a trust, you have to, well, you can be knowledgeable, but you have to be an attorney to do trusts, to set them up and that kind of stuff. So none of us are attorneys. We don't play them on TV yet. So I've learned a lot about trusts, but I probably don't even know 1% of what there is to know about them. But we do have people that we do work with that do trusts, so that we just refer people over to them. We're not tied to them in any way, shape, or form, but they do understand infinite banking and trusts. So if you want one, a recommendation, just reach out to us. We can give you one.
Yeah, come to the 3-day. There'll be someone presenting on, I think, one of the VIPs for the trust. It'll be the day after I talk about how to set your family vision, how to set your values, what do you stand for, what do you stand against, and how to start passing on that knowledge. And then you want to solidify that with a trust. So they'll preview what's coming.
Yeah. And I've actually created lessons on trust, but I had an advisor, Kevin Day from Robert's group, Kisaka's group, was one of those guys. And my head would just start spinning sometimes when he was talking, because he has so much knowledge. But that's who you want to talk to, someone like that for sure. And yes, so Robin, so the upcoming conference, that 3-day that we just put the link in there, it's definitely for newbies. That's specifically who I would recommend go to that event, right? But anybody that's even doing infinite banking or around this should go to that, because you're going to learn new things. All of us here will go there and learn new things, even though we're doing infinite banking every single day. Continue learning. That's the whole thing. And so definitely recommend attending all that kind of stuff. And then, so Tony says, yeah, direct versus non-direct, that's their term. Yeah. I watched the video of Chris this week, but couldn't remember the term. Yep. There you go. Yeah. And does anybody here have a policy with a direct recognition company? I know Chris does, and he has.
A number of our team members do. And I know one of our main team members, she's like, well, she's not afraid of a direct recognition company. She's just going to handle those policy loans a little differently than the non-direct companies, and probably pay it back before any of the non-direct companies. But yeah,
they work. They work. Like if you go through the certification for the Nelson Nash Institute, right, to be a certified practitioner, there's not a this is good or this is better kind of thing. It's like they both work for infinite banking. You just got to know what you're doing. You got to know how you're using them. And again, it's just working the system, but they both work.
Yeah. And here's the key thing to that one. Good point, Jason. The agent, if they're using Penn or Guardian, Northwestern, the agent has to educate the client on what direct recognition is. And unfortunately, a lot of those agents, and this is my opinion, do not do that. The amount of clients I've talked to that are new people coming into us who have existing policies with Penn or Guardian or even Northwestern, they don't know that what direct recognition is. The agent never told them. They sold them on infinite banking and all that. I don't say sold, but that's how they got them in. But they didn't teach them about how that company operates for infinite banking. And that just to me is a disservice. So I have educated hundreds of people on that concept that have existing policies. I even had a guy that had $300,000 of cash value with Penn. And he called me saying, hey, I talked to my agent and he couldn't tell me why the dividend rate is not what he said it should be. I'm like, are you kidding me? I told him exactly what it was. That guy got off the phone call with me so fast because he was going to go call the other agent back. And he goes, I was on the guy for an hour and he wouldn't tell me that. And I go, and you told me in 5 minutes. I'm like, well.
And I think that is important, Brian, because even for myself, this is what tripped me up in the beginning. I didn't realize, because I hadn't experienced a non-direct recognition company. Most of my work was in property and casualty. So I didn't realize this was actually a normal process until I got more around this campfire. But you're right. If you're selling the insurance, you should know that.
Yep, exactly. Yeah. I like this one. Dexter says, be like Shane. He's on all channels.
Yeah, there you go.
We got some love for Dex and Shane in here. Those guys are everywhere. Thank you, guys. You guys are awesome. Yeah. You're always here supporting. You're supporting the new people. And this is the accountability group, right? Like, look to people like Shane and Dex. Like, if you're terrible, just awful, right? And you want to be better at this than you are at gaming, then follow people like Shane and Dex, and they will lead you to the promised land.
Yep, definitely. Well, awesome. Steven, you want to take it away? Where's Steven?
We got it. We got this. So we did it. We have another Ask Me Anything, the last one of 2025. Who could believe that it's flown by so fast? We're so excited that you bring us your questions every week. And more importantly, you bring us your attention and you commit to learning and growing. So we are blessed to have all of you here. We'll see you next year on Ask Me Anything. And until then, happy holidays, Merry Christmas, and we'll see you on all the other channels we're doing.
Merry New Year.
Good?
Great job, Simple. Thanks, guys. See you next time.